This is John Michael with Peridot Consulting, and what I'm doing here is I'm just going to do a brief walkthrough of what a S-Corporation tax return looks like. That is Form 1120S, and obviously we're doing this with a made-up company. We call this company Practice for Fun, so if you see some of our other videos, we use Practice for Fun a lot, but this video is just meant to talk to you about what an 1120S tax return looks like, if you are an S corporation, how to read it, what to look for. We provide this video for clients with their tax return as a way to understand how to read their own tax return, but also just a good way to understand how an S corporation works as well. As with anything, you'd always reach out to us if you have any questions. But to get to it, the first thing when you open a tax return, first of all, we're looking at my tax software here. It allows me to jump around much easier between the forms when I do this video. The copy that clients get is a PDF copy. So when you open up the PDF copy, I believe the first page is going to be this cover letter here. This cover letter just is straight to the point. It tells you right here if you're going to owe anything to the federal return, and per this S corporation it says you don't owe anything to the IRS. It is saying, however, you owe some money to North Carolina, and we may change that when we get to North Carolina. Some of you may not be in North Carolina, but a lot of states have what they call a taxed pass-through entity tax. This return right now has it not being taxed. That's why it's $200. $200 in North Carolina is a franchise fee. Everybody has to pay that. You do get a credit for being an LLC, so in actuality, when we do this, this will be zero. But I wanted to illustrate a balance due here, so it says that. So when you first open your return, even the individual returns have this, or any return has this, read this, and it will tell you, to the point, are you going to owe any money with this return or not? So that is key. Otherwise, you're going to have to go through these forms and figure out, do I owe or not? This letter just gets right to the point and says, if you owe money, and on other returns down here have estimates, but when we get to individuals, that probably applies more there. It may apply in C corporations. But when we get to North Carolina, we'll talk about this franchise tax there and stuff. And if you don't have a North Carolina return, you could either disregard that section, as I'll do it at the end, or a lot of states are similar enough, especially when we talk about the pass-through entity tax. So this is a Form 1120S. It is a federal form for the S corporation. You can see it right here, U.S. income tax return for S corporations. When we talk about the IRS and this Form 1120S, I always like to say that the S-Corp tax return really is just an information return. It just provides a lot of information about what's going on for your business during this time frame. It is a calendar year. There are times when you can elect for it to be a fiscal year. The difference between a fiscal year and calendar year means, well, it's January through December. It's a calendar year in. That's the period we're covering. Sometimes you can elect for it to be a different fiscal year. S corporations typically not, but there are times when that can happen. Generally speaking, the only time you're going to have a fiscal year return, which means a non-December year end, is going to be when you're in a C Corp, and you can watch the C Corp videos over there if you want to hear more about that. But typically speaking, a S corporation is a calendar year, so we're talking about the period between January and December. So this is information. We're doing a 2023 tax form here. Realize a lot of you watching this are probably into 2024 or beyond, and if tax laws change, we're going to change this, but 2024 is extremely similar to 2023, and this is what we're going to be presenting here. It's going to be read the same, and it's similar enough that not much has changed. Okay, so what does this front page tell us? It is an income tax return, so it gets right to the point. It's your income on this very first page. First, we have to tell the IRS when did you elect to be an S-Corp, so they can verify that. A lot of times people think they've elected to be an S-Corp. You have to file Form 2553, 2553. Sometimes that gets filed. Sometimes the IRS doesn't get it processed um, correctly, or there may have been something wrong with the form. So what will happen is you may get a notice saying, "Hey, look, we don't have you as an S corp." That just means you have to refile that 2553, and you can file it back to the date of which you elected it. You could do it up to 3 years back. So anyways, who are you? What's your address? So if you're reading this and reviewing, make sure that these are correct, that your address is correct. A lot of times people may move. Tax software rolls over from last year unless the tax preparer is well aware or made that change. Sometimes the address will just roll over from last year. So double check the address. That's always something to check. Always make sure your tax ID is correct. Over here, this is your tax ID. And then when you formed to be an S-Corp. This right here, this business activity code, this is a code, it's an NAICS code. It's telling us what industry you're in, so you can look that up, but you could also look on the next page. This is a mock brewery tax return. This could be if you're a therapist or a real estate agent or a construction whatever. This is where you're saying what is it you do and what do you provide. A lot of times that's just the same thing. But this NAICS code, if you were to look that up, it probably says breweries. So it's a code that the IRS uses. Now that's an important code because if we put this code here as a brewery, and you're a real estate agent, and we got some stuff here that would be fine for a real estate agent but not for a brewery, it may, we don't like the term red flag, but it's how they do their algorithms. So these codes, they sort of find averages for the average company within these codes, and if you are doing something that is outside of that average, it may cause some interest. So if we were to do this code but do a real estate agent's tax return, it would be different, and it may cause them to want to look at it. That's all that code does, is it puts you in a sort of a bucket, classification bucket for other like or similar returns. It's also for analytical data and industry data and studies and all types of purposes. So that's why they want to put that there. So you do want to make sure that when you're reviewing this return, you may want to Google that, check that out. A preparer could easily, get that wrong. It's not going to, it doesn't mean your return's wrong, doesn't mean anything major, but it just, maybe you're in the wrong classification code. So it is something to double check. Right here, are you looking to be a tax corporation this tax year? And no, because this is from prior years, right? Anything, is this final? If this is the final year you're doing it, you have to mark it final. If anything has changed, if you did change that address, we do need to make sure we check that box. If the names change, you check that box. A lot of people will ask, hey, I need to change my name or something. Well, this is a good way to do it. You just change it and you check a box here so it alerts the IRS that, hey, we changed the name. As long as this tax ID up here ties, they'll get that name updated in their system. So it's a pretty good straightforward way to do that, and to change your name, obviously to change your address as well. And then if you're terminating your S-Corp or amending your S-Corp, you check those boxes here. I'm going to skip this. That's something we don't want to talk about. Okay, so income tax return. This is your gross income. These are your expenses. And this down here is what they call ordinary business income. Again, it's just informational. It's saying, hey, IRS, this company here brought in about $1.5 million, had a bunch of expenses here, and we're going to go through some details on that. And after all the expenses here, at the end of the day, there's $121,000 left over, and that's considered the ordinary business income. You can see that that's pretty much to the point. That's what it is. That's this front page, but details matter of course. But let's remember this 121,648. That's the flow through. I'll be jumping to this page a few times. If you're reviewing this and you're like, okay, look, I don't see my supplies. Where is it? I don't see it. Did you get it on the tax return? Well, there's a statement down here that does all those other deductions. That 123,000. It's right here. There's that 123. So you may, if it doesn't fit in one of these areas, you might need to go to that statement if you're reviewing your return, and you may find what you're missing for here. So there's some brewery stuff or supplies or whatever may or may not be applicable to you. There's that additional. So all this is like, here's a bunch of income, here's a bunch of expenses. If it doesn't fit in one of those lines, we got a statement giving us the rest of those details. And let's go to page 2. Page 2 is sort of the beginning of a bunch of yes or no questions that may or may not be applicable. First, are you cash or accrual? That's very important. Cash, I'm not going to explain cash and accrual here, but basically most S-Corp taxpayers are probably cash. Some may want to be accrual. You can't switch year to year, and if you, well, let me say you wouldn't be switching year to year. You don't get to choose this. Once you choose cash, you're cash. If you do want to switch that accounting election to accrual, you have to file a form, explain the switch, explain the changes and what would have changed if you're switching back and forth. So it's not just something you switch. So the very first year you're doing this, you want to think long and hard. Should I be cash basis or accrual? And very quick description, cash means when you get money, it's income. When you spend money, it's an expense. That's as straightforward as we can get. Accrual means when you've done something to earn that money and somebody owes you that money, but you've done it, well then you record that they owe you that money. You record that. And then the same goes the other way. If you get a bill, you haven't paid it yet, but you owe it, you record that expense as well. So some people may want to be on accrual. Now there's reasons to be cash or accrual for tax, and there's reasons to be cash or accrual for other banking needs or finance needs, and sometimes they're contrary. You may show more income as accrual, but tax-wise you may want to do cash just because you don't want to pay tax on money that maybe you haven't gotten yet. So you think about that. This is a description of what you are. There are some yes or no questions here. Basically, you can review that, and if you see anything that says yes, maybe read it and see if it applies to you. A common yes or no here, as we don't have it answered, is did you do 1099s? Yes, you did do some 1099s. You paid contractors over $600. They were performing services for you. They were applicable for a 1099. You should say yes there, and you should review that. If it says no, you need to flag it and say, hey, no, that needs to be a yes. And then also, well, if you were supposed to do 1099s, did you actually do them? And that's the second yes. So if you say yes here, you want to be saying yes here. You don't want to say, yeah, I did, but no, I didn't do my 1099s. So if you did, then you better be doing 1099s. 1099s are due in January, the end of the month, January 31st. Schedule K is a great great schedule. It really summarizes what's going on this return into lines. Line 1, what's the ordinary business income? Well, it's $121,000. Where did we get to $121,000? Well, here it is right here. It's all this gross income minus all your expenses. At the end of the day, what matters? Well, the bottom line, $121,000. So we get to 120. Oops, page 3 here. On page 3, Schedule K, we get to that 121,000. It also shows us anything that didn't fit on or didn't get reported on page 1. For example, interest income, when you're a pass-through entity, goes straight to the Schedule K. It doesn't go on page 1. Page 1 is just ordinary business income. They don't consider interest income ordinary business income, so it goes here on the Schedule K. Also, charitable contributions goes here on the Schedule K. It doesn't go on that page 1. So if you're looking and you're like, I don't see my interest income, I don't see my charity, you may want to go to Schedule K, and it would be here, and here's all that extra income items. It also gives us other information down here like distributions. Why is Schedule K important? And I'm going to jump to it. Everybody, when you're a pass-through entity, what does a pass-through entity do? As I was saying, it's just an information return, but the income passes through to the owner. In this case, we have two owners. One is Mr. Practice F Fun, and the other one is Mrs. Practica M Fun. Sorry, we changed our names around. So we got two owners of this. They're both 50% owners. So they get a K1, and you can see here there's some numbers on this K1. Where are they getting these numbers? Ordinary income, interest income. You may get a K1, and all you see is these numbers. Okay, I guess I got $60,000 of income. Where are they getting that from? Well, it's coming from your pass-through entity return, Schedule K. If you're 50% owner, it takes 50% of these numbers here. So this is where the K1 gets its numbers. It takes the Schedule K numbers and applies your ownership percentage to it, and that's what's going to show up on the K1. And you can see here, this is 121,000, and if we were to take 50% of that, that would be 60,824. There's your interest income. So you can see the K1 mirrors that Schedule K. So if you're wondering where that came from, it came from that page 3 there, which came from this line 1 came from that page 1. So you can back into where you're seeing those numbers. But all the K1, if all you're doing is getting a K1, all the K1 does is say that this company here gave this person here, not gave, but this person here is 50% of this company, and this is their share of income. When somebody makes money, somebody's got to pay tax. If a company makes money, the owners pass through entity, the owners pay that tax. So, and if there's 2 owners, well, 50% each. So these two, I'm going to assume they're husband and wife here. They each get a K1 showing their 50%. And there's Practica's K1 as well, showing her 50%. And that is all coming from this page 3 here of the S-Corp. So this is a good place to go to understand what the business did, and your share as the owner is going to the K1, and the K1 is just strictly to the point. They don't care about the details. Just tell us what my share of income is, tell me what my share of interest income is, and this is going to go to the return. When you go to your personal return, you're going to see this come in, and you're going to pay taxes on that on your personal return. You're not going to pay it here. That's why it's called a pass-through entity. Let's go to page 4. Page 4 is a good schedule because it shows us your balance sheet. It shows us the beginning of the year, which was last year's ending balance. So next year, this is going to be over here. It's going to be the beginning balance. So it shows us the beginning of the year and the end of the year. And you can see at the beginning of the year, you had $158,000 in cash, and now it's $230,000. If you had other assets like inventories and stuff, they're listed here. If you had fixed assets, equipment, or something, it's here. Was it depreciated? And then you add your total assets. I think people have heard the term that assets equals liabilities. So you got liabilities plus equity, which is your retained earnings here. So these numbers should equal. If you're reviewing the tax return, you should make sure that these are equal. Typically, they should equal. If a tax preparer is doing it, they don't want to release that unless it's there. Sometimes changes happen, but these need to be in balance if you're reviewing. But it just shows us, the beginning of the year, the end of the year, and what happened in between is going to be explained either on the profit and loss or elsewhere. So this is a good thing. This is, if we do a tax return, we may say we need to know your cash balance, we need to know the ending balance of certain things. That this is why we have to create this balance sheet. Page 5 here, this is probably the place you should one of the places you should start when you're reviewing your tax return. I like going straight to the M1 if you're in QuickBooks. Typically you want to get QuickBooks cleaned up, looking good. Obviously, before you do the tax return, you can't do the tax return unless your QuickBooks or your bookkeeping software is looking good. But we at Peridot, when we clean up your QuickBooks, we get it to a bottom line because we want that to tie to your tax return. But my point I'm getting at is if you pulled up your net income, profit and loss, your bookkeeping software for the same period we're looking at, it should say net income of 118 or whatever is on this line 1. It should tie to your bookkeeping software. Make sure you're on cash basis or accrual basis and you're looking at the right period. But this should tie. So what does this M1 do? It does a really good job of saying, hey, look, if I look at my QuickBooks, I see 118. But I see $120,000 on the tax return here, this 121. What's the difference? Well, the difference is, let's look, and this explains what the difference is. It does a good job of explaining why my tax return income doesn't look like my QuickBooks income. And the key item here, and it's a very common thing, is that meals and entertainment Well, mills may be 50% deductible, so there'd be 100% on your QuickBooks or on your bookkeeping software, but here we back out half, so that is a common difference. You can see here some other common difference, or just blank lines saying, just explain. It's a way to reconcile what's different on your tax return. So when you review this, if this is not tying to your bookkeeping software, you may want to look into why that is, and maybe there's something that's not on this tax return. If something changed on your bookkeeping software after you got that information for this tax return, you might need to update that tax return. So the other item here is the Schedule M2. This can be loaded, but within this item we can talk about reasonable compensation, which is a big item with S corporations and draws and distributions. So in an effort not to confuse, what the M2 does is sort of reconcile your retained earnings. Retained earnings is probably the most confusing thing to non-accountants. But here's your retained earnings. Here we can see last year is 11,400. This year it's 80,000. Well, what happened? Well, here it is. Here's that same 11. Here's that 80. And all of this is the quote-unquote what happened. These items here, I'm just going to save some time here. If you added them all together, it's going to tie to this 118. That is your book income. It sort of breaks it out a little bit into some details, but that is your book income. Other additions are your interest income and stuff. It's just the way the form breaks it out. But basically, it starts with a beginning balance. It goes up by your book income, and it goes down by distributions. This is where distributions come in. Those who take distributions from an S-Corp, this is where you see them. So you definitely want to look at this line if you're reviewing. And you may say, I don't remember taking out $50,000. Well, maybe you did, maybe you didn't. But something happened throughout the year. Sometimes if you're in a business and you're spending money for personal use that has nothing to do with the business, that might come out as a distribution or be recorded as a distribution, as an example. But a distribution is another way that you get money out of your company in addition to, I'm jumping back here, compensation to officers. So in this tax return we had 2 officers, those 2 owners. They gave themselves a cumulative $114,000 here. That would show up on a W-2. Anything you gave yourself in a W-2 would show up here. And if you remember, this reduced this income. So that was a deduction when you gave yourself that W-2. That's a deduction. You don't see distributions there. Distributions are not a deduction. So this is schedule does a good job explaining the theory of a distribution. It's not a deduction, but let's talk about it. So this end balance here, by the way, is going to be next year's beginning balance. This 11,000 was last year's ending balance. So these where these numbers come from. Your very first year during an S-Corp, this beginning balance would be 0. So it starts at 0 or starts at your beginning balance. It goes up by your income. What do we know about your income? Well, we know you're getting a K-1, or the owners are. And we know they're going to be putting this on their personal return and quote-unquote paying tax on that, right? So that's going to be taxable income to them. So we know that if they have income here, if it's positive, it goes up. They're going to be paying taxes on that. Then at that point, if they do any distributions, it brings it back down. So it started at 11,000, went up by the income. They did 50,000 in distributions. It went down, and we had an ending balance. So if you follow that through, that ending balance tells us that a cumulative of prior year incomes, all the ups and downs, they have $80,000 of money that they've previously been paying taxes on that they haven't taken out of the company yet. That's $80,000. So if they wanted to do a $80,000 distribution, they could. It's not additional tax to them because they've already been paying taxes on it cumulative through prior years. Last year they ended with 11,000. So they could have taken 11,000 out last year. They've paid taxes on that. This year they're not. Now this is where reasonable compensation comes in. And this is where the benefit of the S-Corp comes in. So the S-Corp basically, there's a few benefits, but the key benefit that people talk about is self-employment tax. What we know is that when you give yourself a W-2, which is an S-Corp, and you're doing money or you're doing services in the S-Corp, you have to give yourself a W-2. You have to pay yourself a reasonable compensation, and you have to give yourself this W-2. When you give yourself this W-2, you're paying ordinary tax, state tax, but you're also paying Social Security and Medicare when you do this W-2. what happens when you do these distributions? Well, you're not paying Social Security and Medicare, but you are paying that ordinary income tax, because when this K-1 comes in, it is subject to ordinary income tax, but it is not subject to Social Security and Medicare. So when we talk about the tax plan of an S-Corp, the tax plan of the S-Corp is very simple. Well, you have to pay a reasonable compensation. Yes, you have to pay Social Security and Medicare, but you're also paying ordinary income tax on the rest of the income, that $120,000. You're allowed to have money you're paying taxes on already, so you can take that as a distribution, but that is not subject to Social Security and Medicare, and that could be upwards of a 15.2% tax savings if you factor in the employer and employee portion of Social Security and Medicare. So that could be a pretty material tax savings. Some people may be thinking, okay, if I pay Social Security and Medicare on my W-2 when I take it out, but I don't pay it on my distributions, why do any W-2 at all? Well, it's very simple, and there's a very straight up simple rule that says, well, you have to. You have to pay a reasonable compensation. When they ask you, or people ask me all the time, well, what's a reasonable compensation? Well, lucky for us, the IRS doesn't tell us what they think a reasonable compensation is. They don't tell us how to calculate it. They just tell us it better be reasonable. So there's a few ways that you can kind of think of what's reasonable. You can think about, well, what am I doing for the company? What's the average person in my area make for what I do? I'm going to consider that reasonable. Or I'm taking out so much money, I'm only taking out $20,000, but this company made $1 million. Well, then all 20 probably should be counted as salary, right? So also the nature of income. What are you doing? So there's ways to look at it. But one thing the IRS does do when they look at an S-Corp is they do want to make sure that you are paying a compensation. If they want to question it or not, that's one thing. But if this was zero and your distributions were $160,000, then we would have a problem because you are not doing any reasonable compensation at all. So we do have to do some salary on an S-Corp, but you are allowed to do those distributions. So keep in mind, if you're worried about your distributions, you can talk to your accountant or talk to another professional about that. But also keep in mind, you're allowed to do it. You're paying taxes on this money, so don't be afraid of distributions. You're allowed to do it. It's here. It's a mechanism. They don't have this line 7 because it's something you're not supposed to do. You're allowed to do it, but just the governing factor you got to be aware of, am I still doing a reasonable compensation for what I'm doing for the company in order to be allowed to do those additional draws? So that is what you need to look at, and this is what the M2 does is when you look at this retained earnings, we started at that 11, it went up by your income, it went down by your draws, and we ended at 80. So this 80 is telling us that you've been paying taxes on $80,000. You haven't pulled out of the company yet. So theoretically, they can take a $80,000 distribution, but we got to juggle that fact with the additional fact of, are you still taking reasonable compensation of the company? So that's the key thing about the S-Corp. This is a pretty good, thorough, yet brief review of what an S-Corp tax return looks like. Again, page 1 is your income. Page 2, some yes or no questions. Page 3 gets you to that Schedule K, which if it's not on page 1, it'll show up here. Schedule K, again, is where the K1s get their information. Page 4 gives us your balance sheet. And page 5 are those really good review schedules. Schedule M1, you want that tied to your bookkeeping software. A lot of people don't have bookkeeping software. They may say, look, I got an Excel sheet of my income and expenses. Fine, then, I mean, you may not necessarily have like a clean net income number, but you can talk to your accountant or your preparer about that number if you wish to. But that's basically a summary of what your book income, if you had a bookkeeping software, what it would have looked like, because we have the income on your front page of the tax return. And then this is a really nice schedule showing your retained earnings. It's very simple. Goes up by your income, goes down by your distributions. If you had a loss, now I'll talk about that for 3 seconds. Imagine this being a negative 121,000. They had a huge loss this year. It's a negative 120,000. That would bring this into a negative. What does it mean if you have a negative? Can you do draws? Well, no. What's the theory of a draw? It's a return of previously taxed income, right? If this is negative, happens all the time. People may have losses or a few years of losses. They can't do any draws because what is a draw? It's a return of previously taxed income. If this is a negative and you do a draw, then you're what they call overdrawing your basis. You would pull this into the further negative, right? If you had another negative here, because you can see this 130 minus 50. If this was a negative 130, this would be negative 180 here, right? That would be called overdrawing your basis in the S-Corp. And when you take additional money out that you don't have that previously taxed income, it's very simple. It's money you haven't paid taxes on yet. So if you take it out now and you haven't paid taxes on it yet, well, you're going to pay taxes on it when it gets to your personal return. There's a form 7203. It reconciles this. It reconciles your basis. It reconciles the distributions you took. Did you have basis to take those distributions? If it was negative, you didn't. So those will become taxable in your personal return. So be careful. Some people may think they're getting away with something, taking all these distributions. But that form 7203 on your personal return, if properly filed, will end up those being taxed. So you don't want to do that. It also pulls this into a big negative and creates other issues. It's fine. If you have losses, it's not against the law to lose money in a business. Don't be scared if you have losses. You just can't take those distributions. You got to keep that in mind. Don't be worried about losing money. Just be worried about, well, if you need money, the only way you're going to get it out then is if you put it on your W-2. So do keep that in mind if you ever draw that basis. Okay, so that's a brief summary of the S-Corp. You may see some other schedules in the S-Corp. This is just a summary of that cost of goods sold, which gave us where these numbers came from, your cost of goods sold number. That's the 1125A. As you go down in a tax return, typically the schedules just give us more details where other numbers came from. This 1125E is just giving us a breakdown of the compensation of officers. We had that 114 compensation line. This is telling us how much each one got, and they're pretty equitable. They paid themselves the same amount. That's pretty nice. A 4562 shows us your depreciation schedule, where the depreciation number comes from. And you can see there's a page 1 and page 2. Page 2 might be where you see some vehicles listed, or what they call listed property. And then statements give you those details. You see the more expenses. It gives us some. If you're looking and it says see statement on the return, this is the statements at the back. It may just gives us more information. This is your balance sheet. What was that number? Well, it was deposits paid. So the details are there. They just might not be on the forms. You have to go to the statements to actually read the details. There is a big line on there saying $42,000 of other current liabilities. Well, here they are. Are these items were those other current liabilities. So it gives us those details. A common election you may see on most business tax returns is this safe harbor election. It's sort of just everybody sort of checks this box. Basically, you have to depreciate assets. You have to depreciate them, put them on the balance sheet, do depreciation expense, and follow depreciation rules. That safe harbor election basically says, look, if it's $2,500 or less per item, you can go ahead and just write it off as an expense. Call it a supply or something. You don't have to depreciate it. So that's just sort of a catch-all election that if you are buying a bunch of items under $2,500, you don't have to go through the whole depreciation. So if you see that, that's all that is. And just more statements and worksheets. So a statement is something that would get filed with the IRS, just so you know. IRS sees the statements. Worksheets, the IRS might not see these worksheets. Worksheets are just something that's provided to give more detail for information on where things are coming from, or summaries. But the IRS isn't getting that. All the IRS gets is the tax form and the statements. They're not getting this comparison schedule. They're not getting obviously the privacy policy or this cover page. They're not getting these worksheets or these overflow statements. These are just things software provide to provide more information if they want. These K1 comparisons, depreciation schedules, so forth and so on. IRS isn't getting those. They are just getting the actual forms and the statements, and that is it.